Good afternoon, Build members and special guests. Welcome to a webinar on Multiplex's a case study. We're just going to give everyone a few seconds to join the webinar feed and the audio. While we do so, for those of you who don't know me, my name is Tiffany Ellen. I am Build's Director of Membership and Events, and I'm delighted to introduce the Dorr Capital team who will be speaking to you this afternoon. We have with us Brian Dorr, President and CEO, Gerard Caverson, Vice President of Business Development, and Michael Staltari, Assistant Vice President for Origination. They will be walking us through the case study this afternoon. I will not steal any of their thunder. They will share a little bit about themselves as they proceed through the presentation today. As a reminder, if everyone can please put their questions in the Q&A box at the bottom of your screen, that would be helpful. We do try to monitor the chat, but we will give priority to our Q&A box, and we will get to as many questions as possible as time allows at the end of the formal remarks. So with that, I'd like to hand it over to Brian, Gerard, and Michael. The virtual podium is yours.
Well, thank you for having us, and thank you to everyone for listening to us pitch on multiplexes. It's a new-ish product that we have fallen in love with in the last, I guess, year and a half. We have a four-part presentation. I'm going to cover the first two, and then Michael will cover the third, and Gerard will cover the fun part, which is actually the case study. So he's on the hot seat, but he's got a very in-depth knowledge, and I'm sure you're going to see all the ins and outs. It's a pretty detailed case study, and we expect you'll have many questions at the end. Just a brief overview. Dorr Capital, we've been around 15 plus years. Reviewing my personal background, I started my career at Canada Mortgage and Housing Corporation some 33 years ago, which I don't want to admit. And we've worked on many transactions at Dorr Capital. We financed everything from land to major commercial developments. We've seen all types of product over the years. And specifically talking about this one, it is truly unique. Obviously, the government backing makes it very interesting. So when we look at our operations, we look for new investment opportunities. So if you're working with Dorr Capital, you could be an investor in our mortgage fund or in our syndicated business, or you could be a developer that wants financing. So these are all the things that we can do within this space, and we would like to keep going here. So here's what we're looking at: the missing middle product. What I'm showing you here is a 4+1 layout. We're seeing that this is sort of your minimum size that you'd want to do in this particular view. What we like about it is specifically when the City of Toronto, the waiver of DCs, the as of right, and we'll get into what that means, zoning is key to making this a fast-paced, easier to develop with less friction than we normally see for like a development of this size. The other thing we like is the cost structures are pretty good, especially because of the DC waivers, and the time to market. We're in and out in 12 to 18 months. I think this is a win for the lenders. It's also a win for the builder developers. So let's just look at the macro backdrop here of what we're looking at. Long-term demand in housing is still strong, we believe. We're currently in a really difficult market with tons of uncertainty, and which is making traditional single-family development or certainly condo development almost impossible to finance, impossible to sell. I'm saying almost. I'm sure I'm still involved in those markets. They are difficult, but what's really come to the fore is obviously rental in general, but the small multi in particular, at least to us, because we like to deal in small funds, is very attractive. We've got product that, you know, total budgets are between 2.5 to 5 million, depending on what you're building, or if you're doing slightly bigger stuff, you know, 20 million to 30 million. These aren't crazy large budgets, and you're getting swift zoning and entitlement through, you know, in the city of Toronto, plus the DC waiver. So this market, it's like a perfectly timed product for the market we're in. We're all looking for a bit of a safe haven, something to do, something to build out. It's something that the community needs. It's something that, you know, we all need to work on something, and it's got great economics. So, you know, we're very hot on doing this. And when you look at the future tailwinds of this product, right now, you know, there's a bit of compression in the rents because there seems to be a bit of a supply bit of pinch. Yeah. So we 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 see this as temporary, but even still, because the economics of this product, even if you're and the type of units we're building, we're particularly interested in units that are not micro. We personally believe you should be building 2 and 3 bedroom units that are sort of 800 to 1,000 square feet. Like that's kind of where we see that this product should be, given the cost structures and the rents we're going to get. You know, they're going to be north of $3 a square foot. Are they going to hit 4? Maybe in some cases, in some neighborhoods. Are they going to be less than 4? Maybe in some other neighborhoods. We're looking at transit-oriented sites, which there are numerous in the city of Toronto. And I don't know if there's anything else I can add to there.
Yeah, I mean, I think just what you're saying between the pressures on the condo market that was so hot for a while, and now with the incentives with the city, this, you know, the housing supply, there's still this demand for living space, livable space, which
Yeah.
became a short supply in last year. So,
And if you look at it, like let's say you're starting a project right now, in about 12 to 18 months, there's going to be a lot less supply coming online. So I think the fundamentals are going to just keep improving.
yeah.
Right? Gerard, you're involved. What do you?
Absolutely.
Yeah.
It's a great way to get, you know, there's smaller numbers, like you say, versus building an apartment building at 300 units, but
Yeah.
how quickly you could do these and guys can start to scale up and do a number of them at the same time, you start to really get some good supply out there.
Yeah. And we're definitely interested in working with guys who want to repeat this and do a bit of a portfolio. We love that idea.
Yeah.
And one thing that doesn't hurt this whole model is that, you know, the homeowner market is down. So you're not competing for sites as much as you used to. So, I mean, this is probably a temporary problem. I don't know how long it'll be temporary. And as a homeowner, I'm hoping it's not forever. But certainly it kind of gives a window, at least at this moment in time, where you can get in before values start to, you know, stabilize and go up. Michael, I'm going to turn it over to you.
Sure, sounds good. So I'm going to take on a little bit of the financing and capital aspect of this, of the structuring of these. The 3 main advantages that we've identified here are the DCs being exempt that Brian mentioned earlier, the CMHC MLI Select programming, and the as of right zoning. So having the DCs exempt is huge. They're big numbers for those builders in here that have created any new units, whether it's a single family lot or a smaller condo or apartment. So having those exempt is huge. Now, there is a little bit of an asterisk, anything to do with, I guess, policy or city policy. They are exempt on your first, I believe, 6 units in the city of Toronto. And then anything after that, if you do get more density, you will be charged. So most of these programs or benefits are very nice high level, but there are still some requirements and technicalities to actually get those achievements. So, but on the quick kind of 4+1s, 5+1s that are very popular right now, we're seeing DC exemptions, which is great. What used to be deferrals are now exempt. So again, just helping the bottom line of these projects. MLI Select obviously gives you some favorable financing terms up to 95%, longer amortization, Also, caveat, you have to hit certain targets for them, whether it's affordability, efficiency, or what's the third one? I think, yeah, accessibility.
Accessibility.
So again, great promos, but really got to know the details on how to achieve that. Otherwise, it doesn't really help you out. And then the as of right zoning that we also mentioned earlier, that technically, sure, you can build, they say 4+1s in the city of Toronto as of right. But every lot in the city is different. You're always going to need to look at whether you can physically deploy these things properly. And as Brian said, we really want to make sure you're deploying livable, proper space, kind of larger units, 2-bedroom, 3-bedroom, versus, okay, I can build 4 units, but they're all going to be really small condo-like units that I think the market is just tired of.
And fully saturated with.
Yes.
So you don't want to be building into more supply of something that's oversupplied.
Yeah, I think the market in general has gotten to that point where they said enough's enough of these 400 less square foot units at premium prices. The people just need more livable space. And if you can partner up with a friend, a spouse, partner, whatever it is, to help with those living costs, that's what everyone is doing now. So that's why this product is a great fit for this market. Typically with these projects being shorter term, developers and builders seem to be able to construct them in less than a year. So from acquisition to stabilization, we put it at 18 months. Typically, you acquire the site, your equity goes in, you'll likely need to take it to a certain point of construction. We've seen it very common to just use term construction financing. The timelines for CMHC are just too long for these smaller timeline projects. It becomes impactful on time, and everybody knows how valuable time can be in real estate and construction, especially when you're borrowing at larger dollars. So time is critical. Which is part of the reason why this as of right is so appealing, because it allows people to cut down their timelines depending on your plan and project. So typically with these shorter term projects, conventional, we underwrite to CMHC anyways ahead of time so that we know, okay, we can do the conventional here. Here's how it looks on a takeout CMHC basis. Everything's somewhat lined up in that basis. And then it's just up to stabilizing at the end to eventually get that long-term 40 to 50 year amortization, cheap financing.
Yeah, and it's an easier process if you're applying to CMHC for a stabilized cash flow asset as opposed to a construction loan. Even though the rate may seem extremely low doing CMHC construction, I think when you factor in the extra time to get it to market, I'm not sure in absolute dollars, it's probably not a very big number.
Right.
So it's not our premise. Obviously, what we finance is we'll do both, but we have funds for doing the institutional, privates, or a mixture of the two.
Yeah, which seems to be more common structure for the smaller. As you get into larger projects, larger timelines, maybe you can sneak in an extra couple months of your financing approval stage. But typically on these small ones, guys want to be in and out within a year. Get your term financing in there, get it stabilized. Don't let CMHC guess about your rents. Get it stabilized, show them what it's worth, and move on with long-term financing. That's kind of been the typical structure here. This, again, just back to what I was saying in terms of timelines, broke it down a little bit more specifically. This is why we like the 18th months. Your project completion is probably within 12 months, bordering on that line. But like we said, we like to see it fully stabilized, and as CMHC does before applying. So that's where we have the extra few months on the back end to get that stabilization and confirmation of refinance. Now, the part of the reason, like we said, that these products are so appealing is they're built for renters. Condos seem to have been built for investors for so long, and the market was just kind of dealing with what we had because that's what the supply was. Now we're starting to see the market fight back a little. The inefficient units are not really getting those premium dollars that they were anymore on both the rent and the sale side. So the market said we need more livable space, and enter the multiplexes where they're built maybe at a slightly higher quality than it's almost condo type quality, but for renters and a much more livable space. So it's a great fix for the pain in the market right now. And the government has done great work to ultimately align these policies with what we're doing. There's still a lot of changes going on with them. Nothing's ever really consistent for too long, but they're working on it. They're taking feedback from the applications from the professionals that are applying here and trying to support this factor exactly. We showed a couple where we funded. They're pretty quick projects, like we said, in and out. Here we've identified the wards that are actually, as of right, sixplexes. So you get a little bit more density. It's mainly the downtown Toronto, well, I guess Toronto core, with one in Scarborough. I think that's where it started, which I was told from my planning friends at Design Build, who are on this this presentation right now. So it started in Scarborough to give the as of right sixplex zoning. Worked out well there. They started to focus more on dense neighborhoods. And now I'm going to pass it over to Gerard to give you guys the numbers and the exciting stuff of the case study.
Here you go.
Thank you. I'm going to give you a high-level overview, and my comments are really a hybrid of my lending experience and developing experience. So what we possess at Dorr is a deep insight into the intricacies of the market and how to minimize the risk. So if we look at this is just a really rough project cost budget. The underlying function here is land costs are not, in this scenario, $950,000. I will draw a couple of conclusions at the end, but this is a scenario that we saw early on in the process. So this particular application was one of the first 10 that was approved by the city. The $1 million still holds true. And we're speaking only of Toronto because Toronto was the only municipality in the province to enact Bill 23, which really provided for the deferral of DCs. Other municipalities are offering similar incentives, but nothing to the extent of Toronto. I'll also tell you that's probably kind of obvious that if you have to start layering DCs onto these projects, they don't make economic sense. So $1 million number is a good conservative estimate to what you're looking at. The reality is $1 million buys you a 50-foot lot north of the 401 or a much smaller intercity lot anywhere from 25 to 30 feet. The picture that we're showing here on the right was a 23.5-foot lot with a mutual drive. That comes with its share of challenges that are reflected in the construction costs. So on the construction costs on this one, if you look at it, the second column from the right, $382 a foot. As I've already alluded to, this was early on in the process. That today is probably $325 to $300. But it's really on how you choose to finish the interiors of the project. In this particular instance, and in most small multis, as Brian's already alluded to, that you're competing with condo properties. So you're looking at a contained unit that includes in-suite laundry, air conditioning, heat, 5 appliances, everything that would rival what would otherwise be a condo. The old rental stock, larger units possibly, but not to the extent that the amenities that are in these small multis. And again, these are conservative because you're looking at it from a finance perspective and you want to make sure that you understand the parameters before you go in so that there are no surprises during the course of construction. Because if you take a look at the bottom line projected profit, shy of 15% doesn't give you a lot of margin for error. So how you save on the cost actually adds to your bottom line. And I'll present some savings to you in wrapping this up. Soft cost budget's high, and it's $250,000, but it includes all your planning, all your reports, your architectural, everything else associated with that. Financing is a big number. So whatever you can do to speed the delivery of the product through to the market is critical to this. And Brian, I'll let you maybe speak to that in terms of how we're trying to minimize the finance costs for these projects.
Yeah, so we kind of have three, I would call three like conventional products. We can offer sort of a lower loan to value, more institutionally priced construction loan. And then we can do a higher loan to value, maybe blended with that. And then, depending on the experience or equity or required, we might have like a strictly private or timing. Could be, we can adjust for timing. We can have like a pure private loan. Price ranges can go all the way from 7 to 10, depending on what you're doing. And when you look at it, even when you look at the price differences, it's really about your timing. The other features that we have or don't have, we can either do escrow funded reserve, but for interest reserves or non. Again, it depends on timing and availability of funds, but we definitely have unique funding for whatever situation you can find yourself in.
Yeah, and I'll touch on one more thing. Is part of the timing and financing costs that you mentioned is being prepared for that full life cycle. So when we talked about getting conventional and then going to CMHC, it's about being prepared for all those steps during the process, knowing how long it takes to actually get through the approval process, get approved, get funding, so that you're not sitting around waiting. So we try and do that fulsome package basically up front to make it as efficient and smooth as possible.
Yeah, we'll even take care of the CMHC application. So we'll do cradle to grave so that you're completely taken care of.
Yeah.
So it's common to have a contingency. You need a contingency. The market is 3.5%, which is the norm, and that's a safe requirement. So what you're looking at is if your land costs are $1 million in the city, your total project costs come somewhere in the 3.7, 3.8 range. And that's a fairly good indicative analysis of where we are. I'll flip through that, but what we're seeing today, and what we're talking about here is not something you can fit into a box, because this box doesn't exist. So it's a lot of manipulating the realities to address the market, to address the lending community, and to accommodate that ask. I will point out that in the soft cost analysis, it also includes cost consultant fees. Institutional lenders who will provide better financing rates require a cost consultant. But in this instance, the cost consultants see the merit in being involved in the market also. So the cost from a cost consultant perspective is a fraction of what it otherwise would be. You can expect initial review of $3,500 and annual every draw request that you do is about $750. So your total cost, depending on how many draws, probably between $6,000 to $7,000. With that, though, comes the expertise that they provide. So I made reference to, you can't fit this into a box that exists. And specifically, if you look at the trades, so we have the luxury in Toronto of having quality trades. In this instance, though, you're falling between the cracks. This isn't a single family home builder, and it's not a high-rise trade that you're attracting. So it's somebody who's fit in the middle, who may or may not take holdbacks, depending on how your contracts are. You may want a quote up front. It gets a little challenging when you rely on, I have a 20-year history with this trade, so I don't really need anything in writing. You're going to have to get something for us, at least so that we can confirm that the construction costs are reasonable. Because everybody will come in and say, I can do it for a whole lot cheaper than $382 a foot. And you can. You just have to provide us with the comfort on that.
And I think that goes back to where I was saying before, the different types of, like, maybe you're not quite an institutional fit, and maybe we go more private with stage draws. We can accommodate that, but everything has a price. So we can adjust if need be.
And I'm going to emphasize this doesn't fit into a box, which is what we like. So everything is unique within the confines, and we're giving you really high level touch points. But what we typically do is work backwards, and I'll get to what I mean by that. So how much money can I borrow, and how much equity do I need? So here it is on the $3.7 million costs. The loan's somewhere between 2.7 and 2.8, and your equity is about $975,000, which is essentially the land blended in free and clear. So if you look at this, at Dorr Capital, we underwrite the loan not only on the end value, but we underwrite it on the amount of mortgage you can otherwise expect under a CMHC MLI Select program. We do not require the COI at the start of construction. And the benefit that we see there is that CMHC guidelines as it relates to expenses, as it relates to vacancies, as it relates to other things are carved in stone. Expense factor is usually 24% of your income, of your gross income. Vacancies are 2.5%, 3%. You can't adjust those. The only adjustment you can make is on your revenue stream, and outside of CMHC guidelines, you're funding on leases that are in place. So it gives you the opportunity to argue a higher revenue stream. To do that, you're probably looking, as Michael alluded to earlier, on an 18-month term to get all of that in place. So that's kind of how we look at these. That's where the market is. So what does this mean? Project value. Project value in this instance is based just on a cap rate. And the cap rate that we've used on the revenue side, which I'll show you on the next slide, is a 4.6% cap rate. Probably high, but again, this is an overview that we can modify depending on certain situations. Project costs of 3.7, loan exposure. You see there that the metrics are familiar to everybody. What I will point out, though, is banks don't finance this product, don't do CMHC. Credit unions fill a void, but credit unions are struggling like everyone else today in terms of the uncertainty in the marketplace. So there's tough markets to do. We've kind of come across that, and Michael and Brian have both alluded to the fact that we will try to credit enhance a facility. And by doing that, your loan to value, your loan to cost will go up because we'll structure it so that there's a component of the overall financing package that will allow you a greater exposure and greater flexibility. We do all of that in-house, and from your perspective, it's transparent. So what does this mean? I'm going to show you, we've spoken about as of right and all of those things. I'm going to tell you on this particular scenario, there's 4 3-bedroom units, just shy of 1,200 square feet, and a garden suite. This is an inner city lot, 23.5 feet wide. If I was building as of right, my 4 1,200 square foot, 3-bedroom, 2-bath units would be 4 680 square foot, really small 2-bedrooms. I don't want to play in that market. Too much saturation, too much competition. So in this instance, there were 7 variances required to get the suite mix that we wanted to address to have a deeper market penetration. And I'm going to touch a little bit of variances on the end, but you want to be really careful on a couple of fronts, right? You want to be careful on the as of right notion, and you also want to be careful on the number of variances. If you're building north of the 401, you're building on a 50-foot lot, your need for variances are much less than if you're on a 25-foot inner city lot. And you're not only looking for front yard setback and side yard setbacks, you're looking at setbacks between the main 4-unit building and garden suite. And you'll see on this one that the garden suite's 500 square feet. That's a smaller unit, but it's really indicative of not only the width of the property, but of the length. So when you're pushing coverage conditions, you're looking at variances and you're deciding what hill you want to fight. Because remember, the second you need a variance, you're a committee of adjustments. And when you're a committee of adjustments, you don't know what pushback you're going to get from the surrounding neighborhoods. Michael, you have a comment?
Well, I was just gonna say that's one of those asterisks I mentioned earlier with your as of right planning that everyone gets so excited about. Well, your as of right, if you only want to build this specific thing on this lot, and then as you talk about what you're building and you want it to be livable, maybe you want them to be 2 bedrooms like Gerard is saying, well, now you got to start asking for variances. Now it's not as of right. Now you're getting into longer timelines, more approval risk ultimately.
But would you say the city of Toronto is trying to address this? Like they've got a whole small multi kind of group, or
City of Toronto's learning like everybody else, and they're actually putting things in place to really move this forward. And Brian, that's a good point. When permits were pulled on this one, and I mentioned that this was one of the first 10 that was approved by the city, you had to complete the 4 units, get an occupancy certificate before you could pull a building permit on the 5th unit. That lengthens the time of construction, lengthens the interest carry, and requires you to bring your trades back. The city has said today, no, we'll let you pull permits for the 5 units and you can go ahead. That's a huge saving. So everybody's recognizing that, okay, this is early on in the process and there's some tweaking that needs to be done. The city's been very helpful in that. And that's a key component to the overall profitability of this. I'm going to come back and I'm going to key on the $3.70 a foot pro forma rent. There's a couple of things you need to look at. And my belief is if you're going to ask premium, and 370 is a premium, you have to offer premium product and you have to build premium product to comply with the offering. So I'm a big believer that you have to increase the capacity to the site to 400 amp. If you choose to do that, it's anywhere between a $50,000 to a $70,000 additional cost because 400 amp service into the site is underground. You're not running it above ground. The difference between 50 and 70, as simple as what side of the street is the transformer on. So it's a sophisticated market and everybody is understanding the challenges and benefits around that. So I presented a conservative view in terms of the costs.
I just wanted to stop you on that.
Please.
On that transformer. The one reason you did that way was for this to catch the MLI Select energy efficiency component, right? Which may or may not be worth it.
Good segue.
Yeah.
So the segue, and Michael touched on this earlier, the 3 components that really drive the CMHC program, and by virtue of the program, whether you're 35, 40, 45-year amortization, the 3 categories again are efficiency, accessibility, and affordability. 370 a foot, this does not comply with an affordability program. So you have to really know your market. You need to know where you're looking at. But one of the benefits that we provide in this is when we come in and we start the underwriting, we work backwards. So CMHC, what do you want to do? CMHC financing, it's a requirement. I mentioned the requirements about the operating expenses, but it's also a requirement to comply with CMHC financing that the borrower has net worth outside of the project that's at least 25% of the requested loan amount. So there's a lot of things that come into play that we know and that we address up front and going forward. But let me walk through this scenario. So this is a best case scenario, and it doesn't necessarily tie into the model that I'm showing. I've commented the value of the property is probably based in today's market, conservatively a 4.6 cap rate to get to the value. If you're looking at the value based on what you can borrow under CMHC, it's driven by your debt coverage. And your debt coverage you see towards the bottom is 1.1 to 1. That's as good as you're going to get. And you're playing in a market that it's too small for institutional. The banks don't play there. That's your reality. There is money available, but it's closer to 1.2 debt coverage at probably a higher rate and not anywhere near the amortization that CMHC will get you. So in this scenario, we're using a 45 year amortization. If I want to bring this back to what the model that I showed, it's a 35-year amortization. Notwithstanding that, though, if you remember what I said, your land is essentially blended in free and clear. And for our example, we're suggesting $1 million is where it is. But you are getting a fair portion of that back, not all of it, but a fair portion of that back when you do your CMHC financing.
Other things you need to think about here, if you're using a 110 debt cover on a small multi, you don't really have a lot of wiggle room when you have a vacancy in terms of cash flow. So you do want to have outside cash flow just to be able to, cover vacancy. And you also want to make sure that your rents aren't so crazy high in your pro forma that you'll never hit it, right? So while it might be attractive to pull all your equity out, if you plan to be a long-term holder, you may want to consider a slightly different. Now, if you're building to sell, which is also a very viable product, I think, maybe you have a slightly different scenario there, but
yeah, agreed.
So that's kind of where we're looking at it. Here, I'm going to give you now a couple of observations that we're seeing. Prevailing cap rate, probably 4.6, but it's anywhere from 4 to 450, depending on where you are and whatnot. I've also emphasized the delta between north of the 401 and south of the 401 and $1 million. The real delta is north of the 401, you're providing parking. South of the 401, you're not providing parking. So you're charging $370 a foot for a beautiful unit, but you're looking at street parking. So for these to work, and our experience is you got to be close to a major transportation route. And that's where we play, and that's where we think the best value is. On the $1 million, and I apologize for harping on that, but if you overpay for your land on this, you're going to be in the same scenario as if you overpay for your land on anything. You're going to be chasing a number that's not market driven, but more importantly, what you need, and I'm not sure you're going to get it. One of the ways to get around that, and it's really dependent on the seller's appetite and your ability to close the gap between what you think it's worth and what the seller wants. If you are able to negotiate a closing that's tied into your obtaining approvals, so the APS will be written to the extent that the seller is allowing you to apply on their behalf because title of property is still in their name, and without cost to you to move the application forward, that's a significant time saving for you. And the time saving for you translates to lower interest costs.
Yeah, you ultimately are shifting some of your soft cost budget and carry cost into your purchase price because you're saving it on time, right? So you're shifting that around. But there's these situations, like we said before, are different on every lot in the city. You can try and generalize as much as we can, even with these policies. There's always asterisks. There's lots of different categories for each one. So we can try and be as general as we like, but ultimately, if you guys have a specific project, the best thing to do is just reach out for that specific project so we can accurately kind of discuss the risks and strategies there.
Two more quick points before we open this up to questions, and I apologize for going on, but if nothing else, you see that we're passionate about playing in this space. The approval process, as I've already alluded to, has gotten a whole lot better, and that again translates to cost savings. But I'm going to end on this. as of right is a bit of a misnomer. So to the extent you need variances, and you probably will because it's more of a market-driven function than anything else, try your best to minimize the number of variances you're asking for. And that kind of makes your life a little easier. That's really going to be dependent on where you're buying. So if it's inner city, some of these small 900 square foot bungalows are renters, and there's really no issues around that. But if it's an established neighborhood, you're going to get a ton of pushback. And it's questionable on where the counselor is going to land in terms of your application. So take away that uncertainty to the best of your ability by minimizing your variances. But to the extent you're asking for variances, make sure the precedent on the street supports your ask. That's about it. I appreciate everybody's interest in this, but we'll open it up to questions, Tiffany.
Great, thank you. Give everyone just a moment to absorb what you guys have gone through. So we do have a couple of questions in the Q&A box. I'll start with those. Let me just bring those up here. So this is from David. He's got two. Does the cost estimate include HST on self-assessment in your evaluation?
Yes.
Wonderful.
No more on that. No more comment.
Again,
straightforward and simple.
conservative,
Next.
right? Our number is conservative, so we've lumped in everything. As I said, this number of the 382 is probably 16 months old at this point in time. So 350, but it does include self-assessment, yes.
Okay. The next one is also from David. With the federal government and various programs changing, what options does Dorr Capital have in the event that the MLI program is not available anymore? So if that goes away,
I'll cover that one. So you know, I used to work at CMAC. I worked in the single family, small multis. I've seen it all. I worked at MCAP, also doing the same program. There is a regular MLI program, and that still exists and probably will always exist. You can buy amortization up to 40 years. You do need a higher debt cover ratio, but there's still a normal program that people forget about that doesn't require any of the extra bells and whistles of, you know, affordable or energy efficiency or accessibility.
Yeah, so there are still other programs. Maybe it's not the flashy 95%, but it's still higher leverage.
But again, you know, depending on what you want to do with this thing, you may not really want a 110 DCR on a 50-year AM. I don't know.
Right.
You know, it's
right.
Tiffany, I'd like to maybe expand on that. In my development days, I was all about leverage. The better the leverage, recognizing I still have to repay it, the better the returns, the better and all of that. What I'm now experiencing in this market is if you're highly leveraged, your ability to weather a storm is significantly impacted. So what we're really talking about here are various options available that can be tailored depending on how you see this going forward. So not a whole lot of play there. The other thing though is it's a very active market. So people typically will try to do it once because they will hear as of right, they'll hear all of these other things, and they'll recognize that it's not for the faint of heart, and they won't do it. But what they would do is buy a site with approvals in place. And on the other side of that, it's a very deep market. If you can mirror the new purpose-built rental with CMHC financing to attract potentially what would be a group of friends or family to buy the unit. So there's a lot of different aspects to this.
it really depends on the project, the space, the municipality, and what you're trying to achieve.
And the borrower specifically, right? What their target of their financing is, right? Everyone's goal is different. Like Gerard said, do you want the higher leverage or do you want some aspect of leverage with breathing room
Yeah.
to work through a storm. So everyone's different.
And there's also an end user market in this. Like it's a little bit different because there's people that actually will want to build this and live in it. So
Right.
so there's a lot of different things we're seeing.
Right.
So
We've got a really good question from Marcus. So these multiplexes, are they considered under the banner of purpose-built rentals? And if so, would those then be HST exempt?
the answer would be yes and yes. That's another good point. Thank you for bringing that up, Marcus. That's an economic factor that makes these also very attractive. Yes.
Um, the end user is the goal in the purpose-built rental HST exemption. So,
Yeah. Yeah.
um, question from Morris. After you build and complete the units, do you go to CMHC for a better loan rate? Or can you? Do you or can you?
Okay, that's an interesting question. I actually theoretically you could probably get a better rate because of the fact that you're not dealing with construction because there's only going to be so many actual lenders that will want to do CMHC insured construction to begin with, especially at the small multi side. Now, if you're building a project over 10 or $15 million, there's probably a bit a wider variety, but I think actually that might work to get a better rate.
Yeah, like I know when rates were increasing a few years ago, projects that had started when prime was in the 6%, and they're now completing maybe over the last year and this year where prime has obviously dropped drastically. I saw some projects with COIs at higher rates, but you do have the opportunity to go to CMHC and say, okay, here we are now in this market. Here's where CMB rates are. Like, let's work this out a little bit. So there is the opportunity to get cheaper financing. Those COIs are typically not valid for very long, which is why we like to go in once you're ready to go and everything's in place. So it's better to just go once, rented, stabilized. Here's the project. Don't really give them too much room for them to mark up the numbers, and at that point you're rolling for the long-term amortization.
Next up is a DC question. Kasra asks, can you have 6 units and a garden suite without paying DCs?
I think the answer is
No.
I think you can get 6 units, but I don't think you can get 7. Yeah.
Yeah. So what I'll say to that is in those specific wards that we showed a map of earlier, you can get up to 6 as of right. Again, with that asterisk of whether you can physically deploy it, how many variances are you asking for in terms of setbacks and things like that. So yes, you can get up to 6. If you want to do 6 plus a laneway, that's still possible. You just need to go through
You still might have to pay a DC for that.
Yeah. And you may above the 6, yes, you'll have to pay a DC, but it will just bring you to the committee of adjustments and various process where now you're looking at the project as a whole, and you may be declined for that project as a whole where now you can't even build your 6. They might just shut it down completely. So you are taking that risk by trying to push density and bringing in those extra parties.
Well, the other thing when we speak about DC exempt, there are DCs that you have to pay. You have to pay educational DCs and whatnot. And those DCs are a fraction of what they would otherwise be, but they're payable when you pull your permit. So those are all things that you need to be aware of. And I think a typical educational DC is around 15,000 a unit. Not inexpensive.
And before you go into the project, you really need to do your research. Right?
It'll all be part of your project
Ward,
economics.
again, your presentation focused on Toronto, but if you're doing it outside of Toronto, you really got to take the time and understand before you say, yes, we want to do this.
Tiffany, probably even more so because Toronto is so informed that they're helpful. And I'm not besmirching municipalities outside of Toronto, but it's new to them. So you're teaching them as you're trying to move things forward. It gets to be challenging.
But I have seen unique situations outside of Toronto, which could be even more favorable, like depending on how you negotiate with the different municipalities. So
yeah,
but it's not. Toronto's nice because it's kind of they've got a nice set of rules and it's a good program. Outside of Toronto, you have to. You could be playing with it.
Yeah, I have a family member looking to do one in Newmarket, and the town is actually very excited because they don't have many or if any doing it. So they were very much supportive of it because they want to see it coming.
Yeah,
right? So
and they'll definitely waive DCs, whether they, or maybe they won't, I don't know, but
Yeah.
anyway. It's not as programmatic.
And the municipalities doing this are doing it for larger units or 50 or 60 purpose-built rentals. The model here that applies to small multis is the same model and same underwriting and same analysis that you would look at from a 50 or 60 unit.
One more question for Morris. Do you need a planner for COA, Committee of Adjustment?
If you have thick skin, no, you don't.
Good
Again,
answer.
be prepared. You don't need it, but if you're going to committee of adjustments and you have a lot of variances, I typically don't ask the question at committee of adjustments unless I'm reasonably sure that I'm going to get the answer that I'm looking for. So in that instance, if it's net new to you, you probably need a planner just to frame the ask in front of the committee, because there is a process. And if you're going to do that on your own, go to a couple of committee of adjustment meetings in advance of that. And if you're still comfortable to do it, give it a shot. It's $7,500 to go to committee of adjustment.
yeah,
If
so
you get turned down, you're going to have to pay $7,500 again to go back in. These are meaningful numbers when you're dealing with a profit margin that I alluded to conservatively at 15%. You got to watch everything.
Very narrow. Another MLI question. This comes from Ian and it's in the chat. So hopefully I understand what he's asking for here. MLI Select requires at least 10% based on the individual renter in Toronto. And the Toronto rent as of 2019 was 1,350. So I think it's a question. Is that still the rate? Ian, you can pop in the chat if I've gotten your question wrong.
Well, the answer, I look at it every single time. I don't really know off the top of my head, but I think, yeah, because it's based off of the average income, of renters, right? And then you basically calculate the average rent, for that segment or whatever. What's interesting though about that is they don't actually tell you what unit size you have to build. So when you are doing, now this is, maybe now we're going to speak out of both sides of our mouth. So if you happen to be doing you want to use the affordable one, you may want to build a micro unit.
Yeah.
Because I don't know how you're going to make the rent work, but that's me talking out of both sides of our mouth. Because the affordable stuff won't really work on a bigger unit.
It's tough without scale, right? If you need to have 20% of your units and you have 5 units, one of your units is affordable. We already showed you how tight the numbers are. Like you need more density for that stuff.
Like that would be like on 10 units, that would be 1 unit, right?
Yeah.
So yeah.
But or if it's 10%,
Yeah.
10% or 20%. But CMHC does have data survey that they put for the rental, the average renter income.
And we can do that calculation specifically if you have like a project you want to send us.
Yeah.
Perfect. And you might want to go back to a slide. This is from Harinder. Your first slide showed a profit of 650,000 plus versus your cost and value on the next slide seems to have a big difference on net profit. Maybe if you could just clarify the difference between those two. And if you want to move the presentation back to the first and second slide,
I would like to do that.
might be a little bit might be a little bit easier to answer the question.
Yeah, that's a very specific question.
Okay, so you have 635 here as the profit.
Mhm.
And then what was the question?
So your first slide showed a profit of 650 plus versus your cost and value on the next slide seems to have a bigger difference on the net profit.
I'm looking at it and I'm sorry, I'm not seeing it.
Yeah, I'm not seeing it. It might be,
Oh, here, it's 650.
Yeah.
Yeah, I see the 650.
Yeah.
Yeah.
650 and this says 635.
Oh, sorry, I see the 635. Where's the 650?
Might be,
Is that the end value? Maybe? I don't know.
Render, feel free to raise your hand if you're able to clarify what you're looking for there.
Or we have a
So,
slide at the end that we changed. Feel free to call us, please.
yeah.
Yeah. Or here, no.
Oh, he said, look at loan to value, loan to cost.
2750. Maybe just give us a
Yeah.
call.
Give us a call to
Yeah,
clarify that
if you
one.
don't mind. Three seven
Sorry,
three three.
good question and certainly important one. So call us and we can try to go through that with you.
Yeah, for
Yeah.
sure.
Oh, yeah, I see what they're doing. The 2750 is
The takeout.
yeah.
Takeout.
Uh,
Yeah.
Yeah.
Feel free to call us, please.
Yeah, yeah.
All right. Last call for questions. We're almost at our full time here. I'll give everyone just another minute in case there's another question. Um, just a more, I guess, altruistic question is if this is a new type of development project that you're considering as a business, from each of your perspectives, what is the one piece of advice you would give to your clients before starting a project
I'll
like
give
this?
my piece of advice. Um, I would say ask a lot of questions and try and have a strong team around you because they are tighter projects and there are certain impacts that can have there are certain factors that can have a very large impact on your bottom line. Even like we said, the as of actually understanding what's as of right and what you can build versus what might push you over the line of the entire project being declined, things like that. So I would say try and have a very strong team around you, whether that's a planner or architects, or your budgeting. Like make sure you're aware of what you're getting into, ultimately.
Yeah, I'm gonna build on that, but I'm gonna think about if you're holding this, there is a bit of work to managing real estate.
Mhm.
And I'm not sure, I mean, I've been at this, I'm even a certified property manager, so I've managed real estate. And I don't choose to have a business in managing real estate, so there's a lot of work in managing real estate, so you gotta look at what your plan is after the fact. You have a manager lined up, how are you gonna deal with the tenants, that kind of thing, so you really should think that through.
Mhm.
Because it really is a business that once you've built it.
Yeah, because if your plan is to sell and you don't, then you're an owner.
Yeah,
You're a
yeah,
manager.
yeah.
Right.
So I'm going to add just two quick points to that, Tiffany, and it's following on what Michael and Brian have said. If you're going to hold this, you're going to, in my opinion, build it to a higher quality so that your expenses going forward are known. That's reflected in your costs. My second point that I will offer is on the whole as of right scenario. Look at what you can do as of right without variances and see what that generates in terms of suite size and mix. And then look at what you would like to do to capitalize on a family-oriented type product, and see the variances that are required. My experience on this is the Committee of Adjustment is pretty understanding and certainly supportive of variances where you're providing larger family units. I think that there's a huge opportunity here because what you're really doing, in addition to providing purpose-built rental, you're providing lifestyle, right? You're in a small, intimate, intercity environment. You're not in a downtown high rise. So there's a lot of merits on both sides of this.
Yeah.
And if I can suggest a theme is think deeply, think deeply about the project, think about where, think about who, think about look and design, not just the financing. So this is not something that you rush into.
Yeah.
It has to be very carefully planned and considered because of depending on the municipality you're intending to build in, the type of end client, whether, as you guys mentioned, do you really want to be the property manager? That is something if you're going to run up that business that you need to be prepared for. So really, it's a don't rush in.
Mhm.
Do not take the movie title. Fools Russian is not a good scenario here. Make sure that you've got the experts behind you to make sure that you've got a good plan in place and make the project successful from the
Well,
get-go.
Tiffany, and I'm going to add to that. Think about everything, right? So we're talking about unit size, we're talking about sweet mix. Where are you going to put the garbage bins? Where are those things going?
Yeah, where the bicycles go. Yeah, it's a lot
All
of
of that
the.
that comes into play because you have to recognize that we're talking purpose-built rental. What we're not really acknowledging is this is a family's home. So there's got to be some pride of ownership. There's got to be some value perspective from their end. It's a fine line, but yeah, absolutely do your homework.
That's fantastic. So we're at our time. Thank you to our guests for joining us and to Door Capital, their entire team for helping us put this on. If you do have questions, please reach out to them. For our members, we will make sure you've got the resources to reach out to them if you've got further questions. Brian, Gerard, and Michael, thank you so much for your time over our lunch hour.
Thank
Thanks,
you.
Tiffany.
Thanks for having us.
Take care, everyone. Bye-bye.